All right, thumbs up out there if you guys can hear me all right. Cool. All right. Okay. Nicholas, Dylan, Colton, are you there? Mario, are you there? Avril, are you there? So welcome back to another edition of Intermediate Accounting 2. I want to make sure that you guys know what's going on here this week. So we're going to finish up talking about chapter 14 today, and that'll give us a nice setup for going into 17.1. So 14.4 is on Blackboard, so 17.1. 17, 2, 3, and 4 won't take us too long to get through. So we may still have some time to do a bit of a review for the exam that's coming up on Wednesday. Realize that on Wednesday, you're going to come to class like this. So you need to have your camera on. You need to make sure that I can see you. If I need to send you a chat to like adjust your camera or whatever, just make sure that you're paying attention to any type of flashing, blinking signals from Zoom, because it means I'm trying to reach out to you. It also could mean that I'm trying to reach out to the class in general in case there's a general question that's popping up. You're welcome to send me a chat over Zoom. If you have a question as well, I don't mind that. Just realize that you can send it to me or you can send it to everybody in class if you think everyone's got the same type of a question on the exam. So it's meant to be rather interactive, but on Wednesday, you need to be on Zoom. You need to go into, when you go into Zoom, okay, go into Blackboard. You want to minimize your Zoom application off to the side. Just realize that I should be able to see you. If I can't see you, understand that it's going to be a 0. So right now, I cannot see Mario. I can't see Nick. I can't see Aiden. I can't see Avril. Or is it Avril? Okay, if I can't see you guys on Zoom, okay, it's going to be a 0. And the reason why is just simply that I need to be able to monitor you while you're taking your exam. If it does become a problem, I'll just switch over to Proctorio and we're going to have to deal with that headache. So I know you guys don't want to deal with Proctorio for monitoring. So option 1 is to make sure that everyone's using Zoom appropriately during the exam. If it's becoming an issue, then we'll just switch it over to Proctorio. Thumbs up if you're with me on this. Okay, good. So that's going to happen during normal class time. So exams are going to start. Your exam, the availability will start at 10 a.m. and you need to start the exam within the first 5 minutes. So if you show up late, realize that I have permission not to let you take your exam. So none of this, I'm going to wait till the last minute to start my exam. It's during normal class time. So make sure you're not going to be delayed getting into your exam. If you think you're going to be delayed getting into your exam on Wednesday, you need to let me know in advance, okay? The reason why is because there's issues with people starting the exam late because they're getting in more study time, more cramming time. It doesn't help them, but they think it helps them. So that's not fair to everyone else who starts the exam on time. So just realize if you don't see the exam popping up on Wednesday, it probably means because you showed up late, okay? As far as exam preparation, your homework is a good starting point. So are your class notes. Everything's coming from your textbook. So just realize you've got the materials. If there is if I do have the time, I'll put up some other practice questions on Blackboard for you to go through. Problem I have with putting up practice exams is that invariably there's always like 1 or 2% of the students who take the practice exam instead of the actual exam. I don't know why they do that, but they do that. So sometimes having a practice exam causes people confusion. So number one thing is when it comes to this class, you got to know the processes. So working things out, that is key. All right, so that is first exam coming up on Wednesday. Then we'll go into 15, chapter 16. I don't think those will take too long to get through. There's some concepts in there we just need to make sure we have down seriously, have it taken care of. It's chapter 20 and 21 that cause the most frustration for people. So, but we should have time. There was an opportunity for me to bring in a guest speaker in the class. I don't know if we will have the time, but if there is a guest speaker that comes in, believe me, I'll give you a heads up about that. So any questions about the exam or what we're going to be doing over the next couple of days? Sure, my microphone's on here. Pow. Oh, yeah, perfect. Okay. So let's jump into 14.4. Top here. All right. Move this sucker over. So there's quite a bit of information actually in this last little section. It's about the fair value option. Now, the reason why we need to spend some time on this is because you're going to see it again in chapter 17. The fair value option, it departs from our historical cost principle. Generally speaking, we as accountants, we rely on objective evidence. So if we say we bought some equipment or building or land, say 10 years ago at 100,000 or whatever, that's generally what we see as the cost basis in the financial reporting system to this date. So we don't really update for fair value. There are certain things that the FASB is sort of making a concession about, and that has to do with any type of financial assets and financial liabilities. And by financial assets and liabilities, what I mean by that are things that have some sort of objective financial value. So in the case of bonds, if we invest in bonds or if we invest in stocks, those tend to be considered financial assets because those are pretty easily convertible into cash. Financial assets don't include things like inventory or buildings. They don't even really include insurance contracts. Some people think, well, insurance is a type of investment, but in the case of financial accounting, insurance contracts are very specific to the actual person being insured. So when I talk about financial assets, I'm talking about things that we can readily sell and turn into cash. Thumbs up if you're with me on this so far. Okay, so financial assets and liabilities. So we can mark to market. This is one in the way of looking at this is called mark to market, MTM. We can mark to market our liabilities as well. And this seems kind of weird. Why would we revalue our debt to market? Well, it's because if we issue bonds, those bonds are likely going to be traded on an exchange, on a bond exchange. So we can find out what the fair value is of our own debt if we go and look at the bond market for our bonds. So yes, we can also revalue notes payable. Generally, we don't because those tend to be very specific contracts with banks. And banks generally do not turn around and sell, don't look to selling our notes on an open market. They may sell our notes. For them, it's a note receivable. They may turn around and sell it to another financial institution. Oftentimes, banks do that, originate to sell. But it's not like they go in an open market necessarily to sell notes, their notes receivable. So why are we even bothering with this fair value kind of stuff? It's a major departure for us accountants. But the key thing you need to understand is it enhances relevance and understandability of financial information. We can get objective information. That's good. That objective information is relevant. It's current. We can use it right now. It's also makes the information more understandable. Because if we're talking about debt that is outstanding, was issued several years ago, we may not really know what role debt plays today for a company. So we may have a we may have gotten into a 20-year note or bond situation, but why do we still have those bonds outstanding? So honestly, having a fair valuation forces us as the company to actually make information more useful to the end user. So I make some references to different illustrations in your book to go back and take a look at things if you need like a refresher on some of these concepts. Feel free to do that. You're not necessarily obligated to do that. I'll bring in necessary information into our notes. If a company chooses FVO, we usually just choose it for non-current long-term liabilities. Usually current liabilities are considered generally at marked to fair value. If we elect to use the fair value option, we need to understand that there's going to be some sort of effect, some sort of consequence where an unrealized holding gain or a loss results from this. A lot of people tend to look at these what are called paper gains or paper losses. Right? Essentially, you look at your investment portfolio, you see it's gone up in value. Is that a realized gain? No, it's an unrealized gain. It's only realized when sold. Okay, we don't realize that we don't really have that cash in our hands, so it's not realized until we sell it. So consider unrealized holding gains and losses just like paper gains. Thumbs up if you're with me so far on this. A lot of people, especially I think, when it comes to financial advice, I always tell people, say, don't get so caught up in your investment portfolio or what you think the fair value is. It's only something that really should only bank on it if it's something that can be readily turned into cash. A lot of people lose lots of value in the stock market. They get too cocky about their investment portfolio because of paper gains. It is also possible that sometimes we report unrealized gains not on the income statement, what's called other comprehensive income. And this is kind of a weird sort of situation. Generally, an unrealized gain is reported in the same way as a realized gain. We will show it as part of net income, but there are some situations where we say, yeah, there's an unrealized gain, but we're not really confident enough to let it affect net income, because you have to understand net income is something that investors, stockholders, look at very carefully. Net income shown on the income statement, information that's on the income statement is eventually closed out into retained earnings. So if you recall from even chapter 3, that's the process. So net income and net loss, when we look at the income statement, we need to understand that net income or net loss represents a change in shareholders' equity because all those income statement accounts get closed out into retained earnings. Retained earnings is on the balance sheet, represents historical net income, less historical net loss, less historical dividends. But what if there are other changes in equity that aren't necessarily performance related? That's where we have this other comprehensive income, other comprehensive loss type of situation. I should say other comprehensive loss. It's summarized in a different balance sheet account called accumulated other comprehensive income. So you sort of have to imagine in shareholders' equity, we've got one account called retained earnings, right? And then that's got the historical sum of all the net income minus any dividends. But we'll also include an AOCI account for things that look like gains and losses, but don't really affect net income. They're really a type of activity that affects the overall net worth. And that's what shareholders' equity is, essentially net worth or net assets of the company. They affect net assets, but they're not really considered earned. They're not really earnings at all. So this is sort of like kind of a mysterious kind of, like I would say like a waste station. We don't know where to put them. They shouldn't be things that affect net income. So let's create a new account called other comprehensive stuff. So this is what it looks like. So in chapter 4, they give you information about how other stuff can be reported. We can take a one statement approach where we show your typical net income. This is your typical income statement information, revenues minus expenses, gets us net income. If there's other stuff that is not really something we want to include as part of net income, we'll create this other comprehensive income section down below. That's a one statement approach. Oftentimes what I see companies do is a two-statement approach where they say, let's keep the stuff that we're confident about in a separate income statement. Call it the income statement. This is our performance. This is incidental gains, losses, revenues, expenses. Those will also be up there. But the things that we're sort of uncertain about, they're not really like your standard gains and losses, but they do affect the balance sheet. We're going to put it in this other comprehensive area and call it the comprehensive income. Thumbs up if you're with me on this. It seems like a weird concept. The idea here is that there's things that affect the balance sheet, our assets and liabilities, that we don't want to impact net income, because net income is reported as earnings per share, and the stock market reacts very sensitively to that number. So if we are uncertain about any type of information, gains and losses, we know that they affect assets. We know that they are the result of changes in assets and changes in liabilities, but we're not quite comfortable putting them in net income. We'll just push them down into another statement. This seems devious. The consequence of choosing a fair value option is recognition of unrealized holding gains, UG, or unrealized holding losses. Oh, right. So generally, these unrealized gains and losses are on the income statement. They affect net income. However, so giving an example here, when FVO is chosen for certain assets, if we see an increase in the fair market value of, say, available for sale securities, we have a market portfolio, we see the stock market's gone up, hey, we get an unrealized paper gain. That's great. We will show a paper gain on the income statement. That's fine because it's objective. We are comfortable doing that, okay? In some situations, though, unrealized holding gains, that would be for trading securities, not available for sale. But if we see an increase in assets overall, the question is, what do we do with the paper? Generally, we start off with the income statement. But here's the problem. When we're looking at liabilities, this seems really kind of strange. I can understand if my assets get bigger because of a market effect, that means I got a gain. If it shrinks, it means, oh, I got a paper loss. But what about liabilities? Liabilities can be valued at fair value, and they can increase and decrease, but you have to look and interpret their changes in a different way. An increase in the fair market value of debt would be a credit. The offsetting debit would be to an unrealized holding loss. That seems kind of weird, but think about it. If my debt, see here, if I'm crediting my bonds payable, for instance, bonds payable or my notes payable, that means my debt is increasing. If I mark my debt to market and the fair value has gone up, that means I've got more debt, and that sucks. So I have this unrealized holding loss, frowny face, because now it's going to take me more money to get rid of this debt, and that sucks. And that's one of the reasons why, if you go back and look at the financial crisis in 2008, a lot of companies were marking their securities to market, and they had a lot of these unrealized losses they had to recognize. It was going to put them into default. But if I see a decrease in the fair market value of debt, that's a debit. That's kind of a good thing. I like to sort of see a decrease in my debt because of the market. And that's just because of market factors. So when the fair value option is chosen for debt, realize that no company wants the fair market value of its debt to increase. It indicates a cost, it indicates a company would need more cash to pay off its debt, hence the unrealized loss. So you might ask, well, wouldn't a company want to, decrease the fair market value of its debt, thereby, making it cheaper to pay off its debt and thereby increasing net income? And the answer is yes. And this is the thing. If we allow companies to mark their debt to market, companies may be incentivized to somehow manipulate themselves and say, oh, we're really in bad shape. We're not even sure if we're going to be able to pay off this debt, right? All of a sudden, people get really scared. The fair value of the debt goes down. All of a sudden, the company looks pretty good, has all these gains. It's a really weird phenomenon. So the catch is the fair value option for debt potentially incentivizes the company's managers to torpedo or sabotage the company's credit risk. The value of the debt goes down, right? Decreasing the fair market value of the debt, thereby making the company's debt cheaper to pay off. In other words, if I make things look worse than they are, the value of my debt goes down. And there's an unrealized holding gain as a result of the accounting up above, and there's an increase in net income. It seems really devious to do that. If a company deliberately sabotages themselves, they can make their debt look really cheap to pay off. This is known as earnings manipulation, and it makes the performance of the company look really well, but it's also fraud if it's deliberate. If a company is actually in really good shape, but it releases a bunch of press releases saying, "Oh, we're in dire situations," they're lying, and that's fraud, and that's manipulative because there is intent to deceive. But doing that kind of fraud also improves the financial position. We see that the value of debt goes down, so they have less debt on their book, and improves their overall solvency and liquidity. So what's the problem with fair value option for debt? Companies might be incentivized to manipulate the perception of their debt. Thumbs up if you guys are with me on this so far. This isn't a fraud class, but you need to realize that there are consequences of choosing this option. That's why accountants, we don't like it. We don't like people having a bunch of options, especially when they have the chance to manipulate things. So bottom line is here, potentially there's some earnings manipulation. Thus, fair value option, the FASB says, has to be applied differently depending on the following conditions. If the company chooses a fair value option and there's some sort of objective macroeconomic market risk that changes the value of the debt, any types of unrealized holding gains and losses, those can be directly impacted to net income, net loss, because those are viewed as objective. Hey, the Federal Reserve acted in a way that makes our debt look pretty poor, or we see that generally LIBOR rates have changed such that the value of our debt has gone down. Okay, so regardless, I'll tell you on the exam if the change was due to a market risk or some type of other credit risk. So unrealized holding gains and losses from market risk changes are reported below operating income in what's called the other section on the income statement. Other revenues, other gains, other expenses, other losses, right? Those are situations when it's objective. And we can verify that, yep, this debt has gone down objectively, not due to the company trying to manipulate things. On the other hand, if the changes are due to credit risk, okay, these credit risk changes are factors within management control that affect the fair market value of the debt. So if a company closes operations or it has a bunch of layoffs or it loses major customers, these are things the company is doing that makes themselves look bad, okay? Maybe sometimes it's things that really are just affecting them because incidentally, they didn't expect to say like lose a bunch of customers, right? But the bottom line here is generally this credit risk is evaluated objectively from third-party credit agencies. So a lot of you might be familiar with that. You probably have a credit score, FICO credit score. There are these, or Experian is a credit valuation company. They value your credit based on your debt history. Okay? So credit risk is usually evaluated, assessed to the individual company, just like Experian assesses your credit risk individually. So if a company's credit risk, if someone comes in and says, I'm going to downgrade the credit worthiness of this particular company because of something they did, or for whatever reason, even if it's something the company didn't do, but they are necessarily being impacted, this credit risk is idiosyncratic. It means it only affects the company specifically. Market risk affects everybody. But if it's something the company is deliberately being downgraded for, it means it's something that's generally under the management's control. The question is a downgrading credit risk due to some sort of manipulation? Maybe the company is trying to torpedo, or maybe it is just that the company is facing bad times. Maybe they made a poor choice. Who knows? But the bottom line is here that if there's any type of change in credit risk, those debt instruments need to be valued at fair value. And if there's an unrealized holding gain or unrealized holding loss, we don't know if it's objective. We can't really trust that it's something that the company would have experienced in any other type of market environment. So this is very idiosyncratic. Should we show this in net income? And a lot of people say, well, they debate this and they say, well, we can't really trust that a downgrade and upgrade due to credit changes is something that should be reported in net income. So let's just put it below net income in the statement of comprehensive income. And so that's where you would put unrealized holding gains and losses. It's not necessarily the fraudulent stuff. It's not necessarily the shady stuff or the sketch type stuff or whatever term you want to call it, right? It's just the uncertain. They're uncertain as to essentially how reliable that gain or loss is, okay? If it's uncertain, it's usually because it may be just a temporary change in the assets or liabilities of the company. Therefore, it's a temporary unrealized holding. It might turn around and switch itself. That's another reason why we put it down there. If it's an unrealized loss today, and then in the next quarter, it turns out to be an unrealized gain, and then the next quarter goes down unrealized loss. If it flip-flops back and forth, right, investors are going to be like, what the hell is going on? We don't want flip-flopping, uncertainty in net income. So that's one of the reasons why we have comprehensive income, is there's things that affect the balance sheet that would have an offsetting effect to the income statement, but because of its uncertainty, we push it down out of the way of net income and just report it separately. Thumbs up if you guys are with me on this. Any questions about that? Comprehensive income is, I would say, by and large, one of the more complicated topics for us professors to explain to people, because unless you've really experienced it yourself, it's sort of hard to understand that the offsetting effects or the consequences of uncertainty in the financial statements. So as an example, I'm kind of sticking with bonds. We're talking about bonds payable. We use a fair value option for the bonds, effective interest method. We value our bonds. We mark to market our bonds. And in this case, bonds are issued at par, but their fair value at December 31st, 2020 is 96. So if we were issued at par, they were issued at 100. Now they're valued at 96. So what is the current carrying value? This is the first thing you want to do, is figure out what the carrying value is at the time we have to value or mark to market our bonds. If they're issued at par, they're always going to be at face value. So this versus 96 means what? Well, a market price of 96 means that the value of the bonds the value of the bonds is less than carrying value. So in our accounting system, we show this carrying value, but what we report has to be the fair market value. That's the difference here. So in this case, what do we need to do to adjust our bonds? We just simply directly reduce the bonds payable account. We reduce the bonds payable for whatever the unrealized, in this case, loss is. And we're going to choose income in this case because it was due to market conditions. It's objective. Hey, shit happens to people. So this is, no, this is not a loss. This is a gain. My bad. Sorry. This is a gain. Go away. Unrealized holding gain is credits. Credits are gains. Sorry about that. This is a gain equals, stop that. You suck. Credits are gains. Okay. Sorry about that. It's market conditions. It's objective. What if, let's see here. Now this is going to sort of throw you for a loop here. You may have to go back all the way to chapter 3. Recall in chapter 3, when we're closing out all of our income statement accounts, we would have to empty this account, reset it back to 0. And where does it go? It's going to go into the retained earnings account. So this market condition where we actually benefited from a change in our debt, that's actually going to affect our overall net income and our overall retained earnings in this case. Thumbs up if you guys are with me on this so far. It's okay to put it in net income. It's a gain, not due to the company doing something. It's something that's a macroeconomic, maybe it's a global phenomenon. But what if It's due to Beerbo being downgraded. So in this case, we still have the debt now being valued objectively at 96. And why is that? Because Beerbo is not viewed as a good investment anymore. So we still have a current carrying value on our books of 100,000, but in this case, we still need to reduce it down. We're going to record a decrease to bonds payable, and we're going to record an unrealized holding gain because, hey, our debt is now cheaper. The value of our debt's only 96. Carrying value is 100,000, but what we report is, oh yeah, our debt's only 96,000. It's some amount less. There is a gain there too. The key difference here is that this unrealized holding gain is going to go to other comprehensive income on our comprehensive income statement. It's not going to affect net income. It's going to bypass net income, be reported as other comprehensive income, affecting bottom line comprehensive income. And then we close it out not to retained earnings. This is my bad, that's a typo. This is going to go to AOCI, accumulated other comprehensive income. Sorry about that. I got a little bit too carried with my copy and paste. So when you're going through this, seems almost like, okay, kind of counterintuitive. So my recommendation is when you're going through this stuff, draw out the journal entries, debits or losses, credits or gains, okay? Plug in the information, know what the final destination is. Just gonna give you a heads up too. I'll write this over to the side here. The balance sheet will have a stockholders' equity section, okay? Underneath stockholders' equity, there's retained earnings, and there's AOCI, okay? On the income statement, we have revenues, expenses, we got some gains and losses. We consider the other stuff. Then we get net income. And then net income, we start with that. And then we add other comprehensive income, or we subtract out other comprehensive losses. Here, we're talking about credit risk. So we're not sure about whether or not whether or not this unrealized holding gain is trustworthy. If there's unrealized losses, holding losses, we're uncertain about that as well. These guys end up affecting what's called comprehensive income. So this stuff you see here, OCI, OCL, those get closed out to the balance sheet as other comprehensive income. All of these net income items, essentially just the net income number, gets closed out into retained earnings. So the major difference here, what's so complicated about this, is just the fact that we've got gains and losses that are holding gains and losses, but we don't want to muddy them up with net income. So that's why we have a separate section of the balance sheet and the income statement. Thumbs up if you're with me on that. Cool? It's riveting stuff, especially for a Monday, I know. So calculate the carrying value first, then compare it to the fair value. And then you figure out whether you get a holding gain or loss. Off-balance sheet financing. This sounds sketchy, okay? And I think it has a sketchy connotation to it because of what Enron was doing. Enron did a lot of this stuff. They were incurring a lot of debt, but you didn't see it on their balance sheet because they were using these other special purpose entities to sort of hide the debt. Off-balance sheet financing is a way to borrow money and a way to prevent recording the debt on the balance sheet. Now, here's the thing you need to understand. When you get to these off-balance sheet topics, realize that there are parent companies, corporations like Amazon, Coca-Cola, and they may own an investment in a subsidiary. Maybe they create the subsidiary at Washington Mutual. We have like 241 different subsidiaries, which is ridiculous. This subsidiary is potentially either wholly owned and 100%. You are annoying me, go away. Wholly owned at 100%, or potentially it's partly owned. Maybe it's something like 20%, right? Bottom line here is there's an association with another subsidiary. The subsidiary is usually set up for a lot of different reasons. One of the main reasons you see subsidiaries set up is for tax reasons. But more importantly, in this case, we're going to set up a subsidiary to get financing in a way that keeps it off of our balance sheet. And this is a good thing, believe it or not. The more debt we report on our balance sheet, on the parent's balance sheet, less likely we as the parent company are able to borrow money, more money in the future, or borrow at reasonable terms. So the idea behind off-balance sheet financing is to say, I need some capital to start up some type of a project, but I don't want to be the one that brings it on my books. It's really something that's for a separate project. If I can put this off into a subsidiary, maybe I can get really favorable interest rates. Either way, keeping it off our balance sheet enables us to manage our overall credit risk, our liquidity, and our solvency. This other thing we need to realize too, if we see on the company's balance sheet any types of bonds payable or notes payable, realize there are things called debt covenants. These are promises, or what they call commitments, to the actual bondholder or the note holder. And some of those covenants can be ratio ceilings, such as debt to asset ratios. Hey, you can't take on too much debt. You can only take on so much. Or there's subordination clauses where a company cannot, company has to pay off certain debt in a certain order. And if it's in a situation of distress, it has to still pay off the senior subordinated debt first, and then everyone else gets the shaft. So these other covenants, one thing to realize about debt is that it's not just about paying back the principal and the interest. It's also about managing these covenants. And covenants can be a form of control. So a bondholder or a bank can have sort of implicit control over the company by imposing these covenants. And as an auditor, every time we went out and did our audit, we have to read through the debt contracts. We have to look at whether or not the company was meeting these debt to asset ratio covenants. When I was at Washington Mutual, I had to make sure that all of the covenants in our agreements with outside investors were met on a regular basis, and I actually had to do a report on a monthly basis as to our status with meeting these covenants. It was a major thing. But you don't see those valued on the company's balance sheet. They are somewhat a form of control. And if we were to value these, we would see a value of debt much higher, because control is something that is burdensome. There's a cost associated with doing these reports. I know, because I freaking hated writing reports about debt covenants, meeting our debt covenants every single month. It was a pain in the butt. It's costly to do that. So if we were to value debt and include these implicit control agreements and covenants, we probably see a value of debt much higher than what we see today. But all we really see is fair value, if not historical cost. Subsidiaries. Why would we set up off-balance sheet financing into subsidiaries? Well, there's two different types of subsidiaries. One is a non-consolidated subsidiary, or NC subsidiary. NCS, as some people call it. You set up a separately registered company with a state. Now, has anybody here, by show of hands, ever started a company, like registered a company? I've done this. It's not that hard to do. You go online, you input your articles of incorporation, you pay your fee, whatever the fee is, and then boom, you are an LLC or a C Corp or a real estate investment trust. It's not too hard to set up a company. You don't necessarily need brick and mortar type facilities. But the key thing is here, parents often set up several different subsidiaries for different reasons below them. If the company, say, owns less than 50% of that subsidiary, it means it's kind of more of a, maybe it has an takes an active part in that subsidiary, but it's kind of like the risk is jointly shared with somebody else. In the case of special purpose entities, these are situations where we as a parent want to set up maybe a company with, like say we want to work with Facebook. Why would we want to work with Facebook? I don't know nowadays. But if I don't have any sort of knowledge or sort of competency in social media, and I want to set up, and I'm a brewery, but I want social media to sort of pump my product I may want to set up some sort of special joint venture subsidiary with Facebook and say, let's kind of design or create maybe an application or some other type of, I don't know, interactive online social media platform. And by doing that, this joint venture, this subsidiary, this JV, right, is maybe partly owned by me, Beerbo, and by Facebook. And the joint venture is really going to be sort of developing new technology. You're going to be exploring new things. And if this joint venture actually finds some type of, researches and develops some type of viable product, I may have an agreement to buy it from the joint venture. So me and Facebook and I, we're just kind of put in some money, some seed capital into growing and sprouting this little joint venture. If this joint venture takes on debt, is that debt something that Facebook should show, that I should show? Maybe it should be 50-50 depending on our association. The idea behind a special purpose entity is that the joint venture acts kind of like its own sort of independent entity. Where is that? I want to put that down there. You're being a pain in the butt. See, it sort of has the appearance of being independent. And the idea is, I want this joint venture to be able to hire employees. The key employees will be maybe mine. Hire employees, take on some debt, go to a bank, establish, some sort of credit with the bank. The joint venture sort of becomes its own little incubator project, but it's not. It has the appearance of being independent, that it's not really controlled by the parent. But behind the scenes, maybe it is me who controls the policy. Maybe the CEO of this joint venture actually is an employee of mine, but it doesn't look like that. Franchises are similar to this. I don't want you to think that SPEs are some sort of devious kind of way of hiding things or manipulating. I say off in the shadows. That sort of seems kind of devious. But the idea behind here is like franchises are kind of like similar in a lot of ways. McDonald's franchise owners have to kick up royalties to McDonald's. Okay, think about an SPE. SPEs do not kick up royalties to anybody. They operate essentially independent. They have some seed capital from these other parent companies, but the idea is to be its own sort of existing being. But behind the scenes, if this SPE builds out some sort of technology and develops financial viability for it, then I, as say one of the joint venture holders, can come in and swoop up and buy out the technology. But meanwhile, none of the debt at the joint venture level is responsible. I'm not responsible for any debt at the joint venture. So the joint venture has its own balance sheet, has debt, but that debt cannot be traced back to me. But I have an agreement where implicitly I'm sort of in control, or have some sort of influence over the operations of the joint venture. It's just legally the debt's not mine. If the joint venture comes up with a product, comes up with product viability, yay, then what I can do is I'll give cash to the joint venture. The joint venture must sell it up to me, the viable product, whatever it is. So it seems kind of weird. This is really contractually organized. The joint venture looks independent, but it's not really. If the joint venture succeeds, I can swoop in and buy out its technology, okay? And then it can be dissolved. In the meantime, the joint venture, the SPE, operates by itself, so I get essentially all the potential gains, but I get none of the losses. And that's why SPEs exist. It's a form of business strategy. I want to create something new, but I don't want to take on a bunch of debt. I don't want to be solely responsible. I'll set up this other entity, SPE, so get it going, but let it run itself, and I'll have an exclusive contract with the SPE to buy out the product if it becomes viable. Thumbs up if you're with me on this.
Dr.
Right.
Question.
Yeah.
So at what point does a joint venture become viable?
It really depends on the product. Usually, if I were talking about, like, let's just say I developed some sort of online platform where, I need to get, like, say we determine viability at 10,000 users or something like that. If the product never even gets off the ground, maybe it starts building up a lot of potential activity. Maybe I get 4,000 users, 5,000 users, and it's going up and up and up, and maybe it gets up to 8,000 users. That may look like this project's being viable, that it's achieving what I want. I want some sort of outreach or customers through this online platform. And Facebook's helping me with this, mind you. But let's just say that after about 6 months, people say, I'm not really going to use it anymore. Then all of a sudden you see these users kind of drop down, drop off. In which case I can say, well, it kind of like maybe it was just a fad where I got a lot of traction initially, but it never really reached the level where I can say, I'm willing to buy the platform, buy the technology, buy the equipment, whatever. I'll just go ahead and just not bother buying it. In which case, the joint venture can sell it off to somebody else. Maybe sell it to Facebook, maybe sell it to Google, or it will just eventually shutter its doors and close down. That makes
And
sense?
then, yes, sir. And then one follow-up question to that. So let's say I reach the viability threshold of like 10,000 users. Uh,
Mhm.
there's still debt. If I become the owner at that point, do I take on that debt?
Right. So what would happen is Beerbo would simply the parent company has an exclusive contract, would buy the tech as a long-term asset and the patents and everything else that comes with it, and would credit cash. And the joint venture would say, thanks, I'll take that cash and debit cash, credit the technology. So essentially transferring the technology and the rights up to Beerbo, and then it would turn around and it would credit cash. And guess what? Debit the notes payable or whatever the debt is, and then pay off the debt. And then potentially just shut the doors at that point. Does that make sense?
Yes, sir. Thank you.
Okay. Any other questions about that? So this is pretty new. This is essentially business strategy, kind of like 101 type stuff. So we as accountants have to be, of course, adept at everything that potentially goes on. So our minds are always running all the time. So it makes our jobs tend to be really exciting when we're dealing with this kind of stuff. So anywho, moving on, presentation analysis of long-term debt. Let me just kind of get down to the gist. See analysis of long-term debt. Where are we at here? Okay. No disclosures. Oh, this is, yeah. Note disclosures are part of the financial statements. They usually occur after the face of the financial statements. And we can take a look at these if we have some time today or later on. The notes usually provide some sort of context behind what we see the numbers on the balance sheet and the income statement. The face of the financial statements is the balance sheet, of course, income statement. But what do those numbers mean? Where did those numbers come from? Why did those numbers change? The notes should provide information about that. So the notes are useful in analyzing the debt, but there's other ways we can analyze debt. We can look in terms of financial analysis ratios. Now, financial analysis often involves some type of ratio calculations. You're probably familiar with this. Ratios are important because when we look at, say, a company like Nike, Nike's a really big company, about 10 times bigger than Under Armour. We can't really compare Nike's balance sheet to Under Armour's balance sheet, right? It's just not very comparable. But we can say, look at Nike's total liabilities versus Nike's total assets, and then do the same calculation for Under Armour. The idea here is that if we've got, say, for instance, let's just assume Nike has, say, 10 billion in liabilities and it has 50 billion in BBN, billion, has 10 billion, 50 billion in debt. So this is your debt assets. Debt to asset ratio is 1/5, or we'll just say that's just 20%. Now, if we look at Under Armour, maybe they have just 1 billion in debt and 5 billion in assets. Now, this looks weird, like, oh, Nike's got 10 billion in debts. That looks pretty bad compared to Under Armour's 1 billion. You can't compare those. Those are apples to oranges. Under Armour is 1/10 the size. So how do we make companies comparable in financial analysis? We scale the information. It's called scaling. Ratio analysis is all about taking numbers within organizations and scaling them down. So you can see down here 1/5, 20%. You can see that, oh, Under Armour has the same debt to asset ratio. Or maybe Under Armour's debt to asset ratio is 1/10. Here's something that's kind of interesting too. If you take the 1/10, now we're talking about 1/10 being, what's 1/5? That's 20%, right? If it has more assets, it's really just 1/10 or 10%. So that's actually looking pretty promising. Debt is only 10% of the assets. But you can't really compare. You can look at Nike's and say, we have got 50 billion in assets. Under Armour's puny. They only have 10 billion in assets. Scale the numbers in financial analysis to make them comparable. You can't compare companies just by looking at their raw numbers. You have to scale them somehow. Thumbs up if you're with me on that. That's what ratio analysis is. It's all about scaling numbers. So debt to asset ratios, they're important because they're a measure of long-term company's ability to pay off its debts, or whether or not they'll potentially go into default too. So generally speaking, we're talking about total liabilities. Be aware of this, though. Here's the caution. Short-term debt is included with long-term debt. So it's not like when you look at total debt, you can't really determine how much of that debt has to be paid off immediately. We have other ratios where we look at current assets versus current liabilities, but there are some limitations to this debt to asset ratio. I just want you to be aware of. It does not include any off-balance sheet financing. So if there's debt in a special purpose entity, you are not going to see it in this debt to asset ratio. Also realize that book value is what we're looking at, not necessarily fair value. So assets are typically recorded fundamentally at book value. In the case of bankruptcy, usually you have to understand that this book value is not very reliable. Oftentimes when there's a fire sale in a bankruptcy, companies might only get 10 cents on the dollar. So when you're looking at debt to asset, realize that you're just trying to make companies comparable. But that doesn't, you have to look at other ratios as well, because the composition of this DTA is not very obvious. And you also have to take into account the fact that companies have different long-term prospects, have different long-term horizons too. So debt to asset ratio, it's a good way of comparing, but it has its own limitations. There's also the times interest earned ratio. Now this is a good one because not if a company does have any debt where interest is required to be paid, we can see whether or not the income generated from the core business is sufficient to pay this interest. And oftentimes it is. Companies wouldn't be in debt if they didn't have money, net income to pay off the debt. But here's the thing you need to understand. There are two things going on with the tie. First, you have to determine what net income would have been without the effects of interest expense or income tax expense. It's somewhat like EBITDA, where you're sort of taking earnings and you're reversing. You want to reverse out the effects of interest expense and income tax. You want to kind of look at what is net income before taxes, before interest. Now, when you have that adjusted net income number, how much is that relative to the actual interest expense? Whether this figure is sufficient depends on how much bigger it is versus the overall interest expense. So down below, we go through an example where I give you some numbers here, and I say, let's look at, and I'll just jump down to the tie really quick. I think you guys get debt to asset ratios here. If we looked at net income and we added back the interest expense and added back the income tax expense, right? That would be a much larger number. larger income number. If we take that big number and divide it by just the interest expense alone, we get this number 6.47. What the heck does that mean? Well, it means that our income, pre-tax and pre-interest, is 6.47 times the interest expense. In other words, interest can be paid 6.47 times over just with our income, pre-tax and pre-interest. We can compare that with other companies. If other companies, say, have a smaller ratio, then we'd say, oh, these other companies don't have such a strong ability to pay interest. If the ratio is much larger, we can say the company is sitting pretty. They got tons of cash, they got tons of other assets, right? But more importantly, their income that they generate can pay maybe 10 times over the interest. Banks look at this very, very carefully because they want to make sure that they're going to be paid their interest. Thumbs up if you guys are with me on this so far. Cool. Andy, thank you for not giving me the middle finger. I appreciate that. I'm just giving you a hard time, Andy. Andy Kwan, hi. How are you, sir? Just saying hi. All right, so it is 10:57 on my clock right now. So let's go ahead and take a 10-minute break and come back at 11:07. See you in a little bit. Where we at here? All right, who has not voted on this? Remember, I'm tracking attendance with this sucker here, so make sure you have voted, even if you're just guessing. I usually don't judge you guys based on these answers. These are just ways of just checking to make sure you're paying attention out there. Who hasn't voted? I see we got one person who hasn't voted yet.
I don't think I have.
And who's that?
Mario, curious.
Okay, Mario. Did you want to vote on that, or?
It's just not on my screen. Like I don't have the prompt up.
Okay, well, it should be up there. So let me do this. All right. Let me launch another one here. Okay. Poll. Let's see here. Stop. Share. Let's try this. All right. Everyone should see this poll on their screen. Okay, yep. Still waiting on 5 people. Who has not voted? Still waiting on 3 people. Two more people. Okay, 2 people who are not voting. What's the deal? Who has not voted? Eli, Cole, have you voted? Charles, have you voted? Okay. Kaylin, have you voted? Royce, figure this out. Okay, so yes, you need to have you need to come in during the exam on exam day. Show up to Zoom as per usual. Make sure your camera's on, and then you can just sort of like just minimize Zoom off to the corner and go about doing your exam on Blackboard. Your exam on Blackboard, by the way, will be. Let's see if I can sort of show you the general place where it's going to look. Stop sharing results. Let's see here. I'll have your exams listed over on the left-hand side right here. So you'll see exam 1, exam 2, exam 3, and final exam. And I'll send you just like a screenshot so you just know where to look on the day of the exam. But other than that, like you'll just kind of take just minimize your, like I'm currently clicking my minimized Blackboard Zoom app over here on the right-hand side. So you'll just minimize that and just go about doing it. And scratch paper, all I ask you to do on the instructions on the exam is to, if you have 1 or 2 or 3 pieces of scratch paper, I do usually just ask you to sort of hold them up to the screen and show me that they are blank. All right, any questions about that? This is fun stuff. Intermediate accounting 2. In summer 1, you can't beat it. Sure you can. Okay. So chapter 17, a lot of heavy concepts in accounting in the first learning objective. So first learning objective, we're going to talk about debt securities. It sets us up for what we need to do for the equity securities too. But just realize companies can invest in other companies, okay? The key thing about the equity securities is the question comes down to whether or not the company is buying stock in another company just because it has passive cash sitting around, or whether or not the company is investing in another company because it's trying to take it over or control it, okay? Debt securities generally just mean passive investment overall, but we'll talk about equity securities in a little bit more detail. We'll talk about consolidation methods, but that's really more of an advanced accounting topic. Other issues related to debt and equity securities are pretty light. So depending on how much time we have, we may or may not get into that. So I'll just leave those notes out there as being robust. So describe the accounting for investments in debt securities. Investments in debt securities, why do we classify, why are we worried about distinguishing debt from equity securities? Well, generally speaking, debt securities are pretty low risk, but low risk also means low reward. So companies will take some idle cash and invest in debt securities because they're not really interested in playing around in the market. They have some idle cash. Let's say idle, right? Idle, not idle. Like I idolize money. When I talk about idle cash, I mean essentially just cash that isn't doing anything. Now, if you actually pull down a company's 10K financial statements, like say for instance, Starbucks or Apple or Nike or Under Armour, you'll see that they have millions, if not billions of dollars in cash. I think last time I downloaded Nike's 10K, they had like $8.6 billion in cash, just in cash and cash equivalents. It had something like 900 million in investments. But you can see like the problem that the bigger you get is the problem you have so much cash, you don't really know what to do with it. Well, you can invest it, right? But companies that invest usually should invest in themselves. So this notion of investing, right, is sort of a broad term. We can invest in ourselves. A company can invest in itself by, say, buying long-term assets. That's considered on the statement of cash flows, we call it cash from investing activities, cash used for investing activities. A company could invest passively by just buying some stocks, bonds, ETFs, whatever, mutual funds, things like that. Just take some of that cash and make it work for us. It's not doing anything in our checking accounts, so screw it, right? Or it can sort of buy another company. And by buy, I mean buy for control. So we want to be careful in how we distinguish our investments here. Debt securities are generally just very, very passive. That's what we're talking about here. So otherwise, the concern we have is whether or not they're trying to control another company. So we are the investor. So if we're buying bonds or any type of notes, we are the creditor now. So it's like we are the bank. Believe it or not, creditor essentially means that we're the ones that put the money in. We're investing. We hold that debt. The issuer now is who we were in chapter 14, the investee or the debtor. Key features about debt securities, okay? They have a maturity date. There's an end period in mind. There's some sort of contractual obligations associated with this type of investment. It makes it very predictable, which a lot of investors like. Types of debt securities, obviously we talked about corporate bonds in chapter 14. Government and municipal bonds, obviously those are a very secure type of investment. Municipal bonds have the advantage of usually having tax-free interest. So revenue you get from interest, in this case it's interest revenue. Municipal bonds tend to be tax-free. You don't have to pay taxes on those types of interest. We'll talk a little bit about convertible debt, I think more in chapter 16. But different types of debt, different types of features with those debt. Categorization, you got to be able to, you might remember this from 2300. There are three general classifications or categorizations. I don't like the word classify, categorize. Held to maturity securities means that we have no current plans to sell the securities. We will likely hold them to their maturity. That's why we call them held to maturity. Not really that tricky or clever of a title. What about the next category, available for sale, AFS? We have no current plans to sell these securities, but we're not likely going to hold them until their maturity. That's why we call them available for sale. If it was held to the maturity, we'll never sell them. And we're not quite sure when we'll sell them, but we know we will not hold them to maturity. They're just available for sale. Trading securities are usually for companies like, say, Goldman Sachs, right? Or JP Morgan, right? These are companies that are in the finance business. They're the ones who are actually making plays. Hedge funds likely have some trading securities. These are these are always going to be short-term in nature. There is a current plan to sell them, usually when there's an uptick or some type of target price reach, and definitely will not hold them until maturity. Okay? So these are like kind of like playing double dutch. I'm waiting to get in, I'm in, and then I'm out, kind of a thing. Very short term. So this is like for the big players in the market. Thumbs up if you guys are with me so far on this. Reagan, how you doing? Great, just smiling. He's like, couldn't imagine doing anything better. All right, debt categorization. So here's kind of like a summary of where we're about to go here. Held to maturity, okay? You'll recognize a lot of these concepts. We're going to record these at amortized costs. So generally speaking, what that means is if we buy them at a premium or discount, we're going to amortize those premiums and discounts. Are there any types of unrealized holding gains and losses? No, because we're going to hold them till they mature. So there's never really a concern about selling these. Hence, we don't give a rip about whether or not these are valued above or below what we paid for them. We'll get interest revenue. If we sell them, we'll have gains and losses that we record on the income statement. And that's the same for all of these too. Right? If we get interest revenue, it's all just part of net income. Gains and losses are other gains and losses on the income statement. The tricky part comes into with available for sale securities. These are reported at fair market value. Okay? The reason why is because, and this is generally the case, if the securities are regularly traded on an exchange, which in this case, just go ahead and assume that they are. Rarely does a company buy debt securities bonds privately. They like the ability to sell these on an open market if they need to. So in the case of available for sale securities, realize that we don't plan to hold these till they mature, but we can sell them whenever we want to. So these are kind of just available for sale. If there is any type of fair market value adjustment that results in unrealized holding gains or losses, we're going to show these in other comprehensive income, and those will affect ultimately comprehensive income, comprehensive loss. The reason why we put these unrealized holding gains not in net income but in comprehensive income is because these things will flip-flop back and forth. They're probably just temporary fluctuations. All changes in the markets are temporary when you think about it, right? So if these things are available for sale, we don't have long-term plans, right? But these things are not going to be sold quickly. So if these things happen to have an unrealized losses period, we'll probably hold them. Next period, they have an unrealized gain. Why worry about flip-flopping back and forth? Stick them in comprehensive income. Let all those market fluctuations take place outside of our normal net income. Trading securities, we plan to trade these quickly. So if there's a fair market value change, we'll just go ahead and put those on the income statement and let those affect net income. Thumbs up if you're with me on this so far. We'll go through this sucker one by one so you'll see what's going on here. HTM. Companies have to declare. When I was an auditor, one of the things I did was I had to go talk to the controller or the CFO or get some sort of representation about their intention regarding these securities. So if the manager came and told me we have the intent to hold these to maturity and we have the ability to hold them, we're not in any hurry to get rid of these, then I would say fine. They're held to maturity, class categorization is good. Screw you. Amortized cost, not fair value. Okay, we're not worried about changes in the market. If there's a premium or discount, we can use the effective interest method. We can also use a straight line method as long as it's similar, roughly immaterial difference with EIM. So same as chapter 14. A lot of the calculations you'll see below follow the same process we just saw in chapter 14. The main differences are you want to focus here on the journal entries. So in this case, we are Beerbo, but we now are purchasing bonds, 100,000 face, 10% stated, 5-year, semi-annual. In this case, we'll just go ahead and keep it simple and say the interest is collected on June 30th, December 31st. We don't worry about interest. In this example, I say let's not worry about interest receivable. So, but if this has a January 1st, if it has a January 1st payment date, realize that we have to use an interest receivable account instead of cash. On the date of the bonds were purchased, the market rate was 10%. Seeing there's a fiscal year end of December 31st. So things are sold at par. Beautiful. When we get them, there's the calculations. We've seen this stuff before. No amortization. What are the journal entries? We're just going to go ahead and record it to debt investments, credit cash. Okay? So we're not talking about bonds payable. We're talking about debt investments. If we get interest on the 31st and the 30th, we'll go ahead and debit cash. Realize that this account would be interest receivable if one of the payments fell on, say, January 1st. So in this case, I'm trying to keep it simple. Just keep it all before the reporting period end date. We got the cash, cool, record it as interest revenue, not really worried about interest expense. Other key thing to realize, there's no year-end adjustment to fair market value. And these are held to maturity. We don't give a rip what the market's doing. When these things mature, and they will mature, and we will have a journal entry, this is what we record. We get the cash based on face. That's what we expect to get. The debits account goes away. So it's almost overly simplistic, right? Fine, it's a baseline. You guys get where I'm going with this, right? Thumbs up if you're with me so far on this. Okay, that's our baseline. Let's look at, see here, buy and hold debt securities. Now we're gonna have a discount, and we're gonna worry about the effective interest method. Oh, let's go row by row with this. So in this case, let's go ahead and assume the bonds, when we bought them, the rates were 12%. So when we bought these things, there was a quoted price of 92.6 roughly when we bought these things. So we bought these things at a discount. Okay, fine. What is the journal entry that we record at the purchase date? Now this is tricky here. Okay, we credit cash 92,640, and we debit all of it to the debt investments account. We do not separate premiums or discounts. Okay, so be careful when you're reading through these problems on Wednesday. This is an investment, so we're not going to have a separate discount or premium account. Okay, so this debt investment is essentially the face minus whatever the discount is, all thrown in the account. A lot of people tend to ask me, why don't we separate these out? I said, we can if we want to, but it really is just more of a headache. We don't really, you'll see down the road here that it's actually simpler if we just throw it all in the debt investments account. Blend it all together. What happens when we get our first interest payment date? We get the cash based on stated. Right, that will always be the same. Interest revenue, in this case under effective interest method, we figure this out first based off of carrying value times 6%. And 6% is every 6 months. Okay, and this is our plug figure. Debt investments, no discounts, no premiums. I don't want anybody in this. If you're here listening to me right now, I give you the option to debit a discount account. Do not do it. Just plug it all into debt investments. Thumbs up if you're with me on this. Cool. One of the number one ways people make mistakes on the exam. Okay. Now, let's see here. Is there a maturity date journal entry? Yes, there is. Why? Because these are held to maturity. So we most definitely will collect the cash, the face value, right? And we will close out the debt investments account. By the time the debt investments account, you have to realize debt investments, right, start off at like that 92,640, right? Then we increase it by 558, right? Every interest period. We keep increasing it, increasing it. By the time we get our last interest payment on December 31st, 2024, the value of this thing will be upwards of 100,000. So it's nice. Now, I also get the question of, why don't we just do this in chapter 14? And I say, well, we need to keep track of what the face value is of the bonds for reporting purposes. We need to know that. So for the issuer, it's nice to have separate accounting between discount premium. For investors, screw it. This is what we paid for it. This goes up in value. Thumbs up if you're with me on this. Grace, are you with me on this? Hi. Buy and hold debt securities premium. Just use a straight line method in this case. It's kind of cutting right to the gist. Straight line method. Remember, in the straight line method, we take the total premium, in this case, divide it by the number of payments. In this case, there's 10. So we figure out the amortization first, and then we add it to, or excuse me, in this case, we would deduct it from the cash payment to figure out interest revenue, not expense. Revenue. Interest revenue would be figured out last. Okay. So in this case, again, don't be one of those people that plugs a debit to a premium account, investment premium, no such thing. Plug it all into debt investments, credit cash. Every pay period, we're going to amortize away that premium that's buried in there. In this case, it's 8 by 811. So in this case, we have our debt investments. So not the 108. This is going to be 811, 811, until it gets down to 100,000. Simple, nice, neat, clean, right? And the interest revenue in this case will always be the same every time we make a payment. Thumbs up if you guys are with me on this. This is fun. Winston, you digging this, man? Mr. Lumberjack over there? I see you. Or is it Freddy Krueger Day? I don't know what's going on there. I love it. Is that like a Dickies flannel? Oh, you're making me sweaty all of a sudden. Inspirations. All right. Sale. Now, here's the thing. I throw this in here because there's sometimes people get confused if I give them a question about securities that were sold. Well, these securities are held to maturity. There were no current plans to sell these things. We're going to hold them to maturity. Is it possible we can sell them? Of course there is. Management can change its mind. At the purchase date, Beerbo intended to hold these securities to the maturity, but Beerbo is free to change its mind. Okay. So every reporting period, what we had to do was go and talk to the managers, the CFO, the controllers, and say, hey, are you still planning to hold these to maturity? Yes. Hey, are you still planning to hold these to maturity? Yes. Hey, are you still planning to hold these to maturity? Now we're going to sell these things. Okay. Change the classification to available for sale. That's how it goes. And we have to document. So 2 scenarios. One where we've got bonds are sold at 106, one they're sold at 103. You guys know how to do that by now. Calculate the proceeds. Here's the thing you want to do. You want to make sure you calculate the carrying value first. Okay. Calculate the carrying value after the 4th interest payment. What is the carrying value? Then compare it to the proceeds. Okay, don't get carried away. So down below, carrying scenario A, we calculate cash at 106. Debt investments had a current carrying value of 104, 104,867. So I like to do this. Plug in the cash. That's pretty easy to calculate. Plug in the carrying value. And then last, third, figure out whether or not you got a gain or loss. If it's a credit you need to balance this journal entry out, it's a gain on the sale. If it's a debit you need, it's a loss. Thumbs up if you guys are with me on this. Okay. Don't want you guys making mistakes. Journal entries help save you. All right. Losses. All right. Now, here's the thing. Realized losses. When these are realized, they are realized when we actually sell these things. Reported as usual in the other section of the income statement. So we show gains and losses affect net income. They do not affect comprehensive income. When we have situations where there's other comprehensive income, unrealized holding gains and losses, it gets a little bit tricky. Okay, we can talk about that later. But generally speaking, I just need to make sure you guys know which area they go to. AFS. AFS are like held to maturity in that if we're talking about debt securities, you must still calculate the amortized cost. This is a pain in the butt though, because that's work, and then there's another bit of work we have to do. Generally, we report these things at fair value, not amortized costs. So there's a difference between calculating amortized costs and reporting the value of these things. So we have to do two things. One, calculate AMCO. Two, adjust to fair market value. More work. That's why I like doing this one next. So we have to worry about fair value. Now we will use a valuation account called the fair value adjustment account to keep track of these things, because we know markets go up, we know markets go down, adjustments need to be handled appropriately. So if we've got any type of unrealized holding gains or losses, they do not get shown for AFS. They do not get shown in net income. They do not get affected to retained earnings. They are shown as other comprehensive income or losses that affect comprehensive income on the below at the bottom of the comprehensive income statement. Then they are carried over into AOCI. So again, remember, we're looking at an income statement, right? We've got net income, all that gets closed out on the balance sheet, the balance sheet to retained earnings. If we're towards the bottom, when we see comprehensive income, the OCI is what gets closed out into AOCI. Retained earnings, the other way I'd like to sort of show people this in Accounting 2300, just as a recollection. Retained earnings will include all of the revenues, less the expenses, plus any other gains, realized gains, less any losses, less any dividends. Okay. AOCI shows unrealized holding gains. AFS. I know why you're doing that now. Holding losses. AFS. Why? Because we're uncertain about it. They could flip-flop back and forth. Thumbs up if you're with me on this. Cool. All right. Knowing AOCI tends to be a painful concept for some people. Ugh and oh. So this is what we're talking about. Their comprehensive income. So we're going to do the same situation we saw before, but we're going to say at the end of the year, first year, bonds are valued at 98. So this is a par situation. We are right here. It's current carrying value. 98,000 is a fair market value. So what are the journal entries we need to worry about? So this is kind of going through the same example. This is par at December 31st. We have to not only just make our interest entry, we also have to make a fair value adjustment. So in this case where we see that the carrying value was 100,000 and 98 was the current price quoted on the bond market, then we have a unrealized paper loss. So we're going to debit that. And I say equity here, which basically means that when you see equity, think comprehensive income. Comprehensive income then goes into AOCI. And we'll use a fair value adjustment account. Don't throw it into the debt investments account. That screws up the person. You have to understand the reason why we're very deliberate in separating accounts is because accountants come and go. So a new account coming in, the more accounts that are used to spread out these different activities, the better. Otherwise we get confused. If we plug this adjustment into the debt investments account, right? We wouldn't know by looking at the balance right offhand whether or not that is pre or post any fair value adjustment. You have to look at the journal entries. We don't want to do that. Look, journal entries are just a great way of recording what happened and who did it when. But really, it's the ledger, the T accounts, that really matter the most when it comes to financial reporting. There's no plans to sell this thing. These are AFS. So likely we will not see any maturity date journal entry. We'll probably sell these at some point in the future. Thumbs up if you guys are with me on this. Cool. Carlos just propping up the head. Just keep yourself from banging on this. I watched a funny short clip of a dog doing one of these things, like the head bob thing. It was just like, oh, it's hilarious. Dogs and cats, and we see him like just try. I'm still here. I'm still partying with you guys. Bonk. It's hilarious. Dog and cat videos. What does he do in his free time besides accounting? He watches dogs and cat videos. Okay. Another situation in this case is looking at the discount. We're going to say the same 98. Keep it simple. Where are we? We're 93,790. That's the carrying value versus 96, or was it 98? Let's see, 98 or 96? 98. 98. That's god awful. Go away. 98. Okay. So you can see right off the bat, we are ourselves a nice little healthy gain here. It's unrealized gain. It's a paper gain. So what we're going to do is just plug it. This is a gain. Equity. We see equity think. Other comprehensive income, which goes into AOCI. It's a gain situation. That's the only difference in that case. But again, no maturity date journal entry. Thumbs up if you guys are with me. Jackie, are you digging this? Awesome, man. Try to calm yourself down. I know I may be going too slow for you, right? But it's like you need to just, you're bouncing off the ceilings right now. It's like way too much caffeine for you today. Okay. It's like more. All right. Quick reporting, just sort of, keep everything in perspective. All these, I'm not going to really go through any type of the sale. You know what the sale journal entries would look like. Down below, when we're talking about AOCI, gains are below net income, okay, not up in net income, and they get closed out into AOCI, or in this case, it's a loss, right? First example, there was a loss of 2,000. Second example, there was a gain. So other comprehensive income, other comprehensive loss. These are the key features right here. But I don't want you to think that these are bullshit type of gains and losses, okay? Or, AOCI isn't really income. It's like, there is an effect to equity. The net assets or the net worth of the company are necessarily increasing or decreasing because of these paper gains and losses. The only difference is here, we're just simply saying is, we just don't want this stuff to affect net income. That's all we're doing. Thumbs up if you're with me on this. Okay. There is uncertainty inherent in this. Trading securities, pretty nice. Okay, everything is just, regardless, is going to go into the income statement. So, held to maturity, calculate AMCO. Like AFS, you have to mark to market. Okay, unlike AFS, the unrealized holding gains are reported as other gains. Unrealized holding losses as other losses. These will affect net income, and these will be shown in retained earnings. So you can just ignore this other BS about other comprehensive income. And the reason why is because these things are very, very short term. So the FASB says, man, you might as well just show the effects right on the income statement. This is a short play. This is an interest play. This is a price play, not an investment in value, investment in return, quick return on investments. So everything is what you saw before. Scroll down to, where are we at? Page 14. And here it is. In this case, there's a loss, but this means shown as other loss, which means it's net income, means it affects retained earnings. That's a key difference. Thumbs up if you're with me on this. Digging this? Tyler, are you with me? Gas, man. Give it the gas, man. Bad joke, I know. Right on. Okay. Page, where are we at? Page 15 is the gain situation here. So down below, it's a gain. I'm going to put it into income, which means it's part of the other gains, which ultimately gets closed out into retained earnings. Go. What's the difference? One word. One word. Thumbs up if you guys are with me. As a form of comparison, retained earnings. Gains and losses are part of net income. Boom. Just like that. Madison, how am I doing? Am I awesome? Madison, am I good? Thumbs up. You getting this? Are you camping someplace, or are you in a log cabin? Where are you right now? I'm just curious. I see a stovepipe behind you, right? Are you
I'm in
by a river?
Montana.
You're in. Oh, are you fishing or something, or what's the deal?
My family just lives here, so I came here for the summer.
Okay, and you're so looking forward to taking this class while being in Montana. Yeah,
Yeah.
you're close to my home state, Washington State, Bellingham, Washington, my hometown. So that's nowhere near it, of course, right now, but just FYI, you're in my neck of the woods, if you will. So, all right. Any questions about that? I put up one of the group work assignments on Blackboard for chapter 17. So you can download that and start working through that. That's going to cover all of the learning objectives. So make sure you're going through your book, doing your readings. Use your book as a reference manual when you need to go back and look at something. Something's not making sense in this class, you can always talk to me about it. This video is going to get uploaded, of course, to YouTube, so you can have that available as well. But make sure you're reading through the book, because the book, sometimes people prefer how the book explains things. I'm just coming in and providing you another example. Those are all the notes I have for today. I'm going to get the other remaining notes for chapter 17 up here on Blackboard as soon as possible, as well as the remaining group work. But I'll focus on getting the group work up to you sooner than later. If you have no more questions, feel free to log off. If you do have any questions, I'll hand the floor over to you. Are there any questions out there?
I noticed the homework 17.1, I know it says it's due tonight.
Due tonight? It should be due tomorrow. My bad.
I found Blackboard it was due tonight by 11:59.
But I'll fix it if it's wrong.
And then so on those, I know you have the true and false. I try to upload the one from 14, and the format for the Excel file, instead of saying true, it was saying 1,000 when I upload it. And then
it's going to be, if you go back through my email that I sent out last week, I acknowledge that the formatting will look weird, but when I download it, it looks fine. So that's understandable. So just, go make sure you go back and review any emails I send you, go back and review all of them. Okay. But that one in particular, I acknowledge that when you upload it, it will look kind of jacked up. That's just the way that the Blackboard interprets it and tries to show me it, and that's stupid. But trust me, when I click on the download, and you can check this too, if you try to download it from Blackboard, it will look fine. The file will open up, everything will look fine. What I see on my end will look fine, even though Blackboard shows something kind of jacked up. When I download it, I'll see exactly what you say. Cool?
perfect, thank you.
No problem. Sorry about that, guys. Oh,
Did you
yeah, sorry, this is
say that we need to schedule office hours on Calendly?
Oh, Crap, I forgot to set that up. When eventually. I'm just going to be, right now I'm going to be on it as soon as I get done with this class, I'll be on office hours. So you can just jump in there. It'll put you in a waiting room. And then I'll be, when I see you, I'll let you in. Cool.
Okay, cool.
Yeah. Sorry about that. Any other questions?
I had a couple questions on the chapter 14.2 homework.
Okay. You want to jump in on office hours and go
Yeah,
over
I'll
those
just
questions?
hours for that.
Yeah, let's just do that. Any other questions? It's fun stuff. Fun stuff. All right, guys. Keep getting your reading done, and I will see you tomorrow.